Our next speaker is Ben Dyson, co-author of Modernizing Money, Why Our Monetary System is Broken and How It Can Be Fixed. He argues that a design flaw in the banking system which allows banks to effectively create more than 97% of the money that our economy runs on is responsible for the financial crisis, unaffordable housing, and the government's reliance on unsustainable debt-fueled growth. The proposals were recently featured by the Financial Times. He's the founder of Positive Money, a campaign for a banking system that works for society and not against it. You can find out more information at positivemoney.org, but please welcome Ben Dyson.
It's working. Morning. I think that's working, isn't it? Okay, so about 12 or 13 years ago, I decided to study economics. And the reason was, I figured, economics explains how the world works. So if I could understand economics, I could figure out, how to make the world a better place. And it only took about a year of studying economics to become quite disillusioned, to realize that economics has very little to teach you about the real world and how things actually happen in reality. And I'll give you a couple of examples of how far removed economics has come from how things really are in the real world. Economics basically gives everybody, well, they explain human beings as though they're completely rational, calculating individuals who weigh up the pros and cons of every single thing that you could do to figure out what's going to give you the most benefit. So it will tell you that if you walk into a supermarket, your brain starts weighing up all the different combinations of things that you could buy, everything that you could put in your basket. And through some rational calculation, you end up buying the basket of things that's going to give you the most happiness. Now, we all know that's not really the way things work. You go in there, you see the special offers, you buy some beers and some donuts, and then you get home and you realize you've forgotten the pasta that you needed to cook dinner. We're not that rational. Economics actually says that there is a way of figuring out the formula for happiness, because we're all rational and we calculate things in this sort of mechanical, rational way. This is their formula for happiness. I can't explain it, but so studying this, has anybody here studied economics? Okay, yeah. Well, it doesn't take long before you start to think, well, this has got nothing to do with the real world. And I got frustrated with the course. I wasn't really learning anything that was useful. Did learn one thing that was useful, though, and it was, there's one thing that's left out of economics, and it's the study of money. And this might sound really odd, because you would think economics is all about money. But most of the economic models that they have, they completely ignore the fact that money exists. And they ignore things like banks and financial markets and how they affect the way we all live. There was one day when I was going through the library, this is the library in my university, looking for some really boring textbook that I didn't want to read. And this words on the spine of a book caught my eye. And the book was called The Grip of Death. And the reason it caught my eye was because nothing that's in the economics section of a library should have a title as interesting as that. I used to work in a bookshop, so it bothers me if something's filed in the wrong place. So I took it out, started to figure out where it should actually be, and the subtitle was even more interesting. It was a study of modern money, debt slavery, and destructive economics. So I ended up scrapping the reading list and just spending the weekend reading through this book. And what it explains is the fundamental thing it was talking about was this question: where does money come from? And it's a question that, although most of us spend most of our lives working for money, we rarely ask questions about where it actually comes from in the first place. So if I ask you now, who makes these? Who makes the coins in your pocket? Any guesses? Bank of England, close. It's the Royal Mint working on behalf of the government. Who makes these? There's a clue on there, it says at the top. Bank of England. What happens if you make your own? Yeah, exactly, something like this, 2 a.m. one morning. But there's a twist in this story. So most people have this idea that only the government is allowed to create money. The twist is that the government only creates the physical money, the coins and the notes. And that kind of physical money makes up only 3% of all the money that exists. So what about the other 97%? Well, firstly, what is that 97%? It's just numbers in computer systems. It's the numbers that you see when you check your bank balance on internet banking, or the number at the end of your bank statement. It has no physical form. It's just an electronic accounting entry in the computer systems of your bank. And who creates these numbers? It's not the Bank of England. It's the same banks that were implicated in the financial crisis. Every time that you take out a loan from a bank, that money isn't coming from somebody's life savings. It's actually new money that is created effectively out of nothing through some very simple accounting. I'm not going to bore you with the accounting today. But usually when we tell people this, if it's the first time they've heard that 97% of the money in the economy is created by banks and not by the government, they usually accuse me of being crazy. So this is a paper from the Bank of England that was released about a year ago. And this is the way they explain the process. They say commercial banks, that's the high street banks, create money in the form of bank deposits by making new loans. When a bank makes a loan, for example, to someone taking out a mortgage to buy a house, it does not typically do so by giving them thousands of pounds worth of banknotes. Instead, it credits their bank account with a bank deposit the size of the mortgage. At that moment, new money is created. So every time somebody borrows, the bank is effectively creating brand new money. This is Martin Wolf, who is the chief economics commentator for the Financial Times. The way he explains it is this. The essence of the contemporary monetary system is the creation of money out of nothing by private banks, often foolish lending. So the effect that this has on the economy and the world we live in depends on how the money that banks create is used. And so this, firstly, shows you how much money banks have created since 1970. And we've gone from having about 28 billion pounds in the economy 40 years ago to having more than 2,200 billion now. So when we had that economic boom in the run-up to the financial crisis, that wasn't based on anything fundamental. It was effectively driven by the creation of all this new money. And remember that this money is being created when people go into debt, so there is also the creation of huge amounts of debt as well, as much as you can see on this blue line. The green line here is just the amount of money created by the government. So the money created by the banks in the 10 years before the financial crisis here, this is where it went. This is how the money was used. 51% of all the new money that they created went straight into property, into mortgages and commercial property. So if you're wondering why house prices are so expensive, this is a big part of the reason why. 31% went into the financial markets. Only 8% went into non-financial businesses, so businesses outside the financial markets. The idea that most of us grow up with is that banks are there to take money from savers and go and invest it in businesses. But this is actually a really tiny part of what banks do today. And then the remaining 8% was the credit cards that you got on the pre-approved credit card applications that everybody received, this huge bubble of consumer credit and debt that happened before the crisis. So the consequences of this, firstly, there is the debt that is created by this system. Because we all grow up with this idea that money is good and debt is bad, and you want more money and you want less debt. And even after the crisis, the crisis was caused partly because people took on too much debt. So after the crisis, we had people like David Cameron saying we all need to pay down our debts for the sake of the nation. But there's a problem with that. Think about this. What happens when you repay a loan? What happens to the money that you repay the loan with? It disappears. It's exactly the reverse of what happens when a loan is taken out. So this, again, the Bank of England explains this. Just as taking out a new loan creates money, the repayment of bank loans destroys money. Banks making loans and consumers repaying them are the most significant ways in which bank deposits are created and destroyed in the modern economy. So every time you go into debt, new money is created, and when you pay off that debt, the money disappears from the economy. So we can't really say that it's like this, because in the current system, money and debt are the same thing. They're both created simultaneously by the banking system. And money is only created when people go into debt. So when you have, for example, the Citizens Advice Bureau, they do incredible work trying to advise people on how to get out of debt. But the more successful they are in getting people out of debt, the more money disappears from the economy. And we cannot all get out of debt in this system because it drains money from the economy and risks causing a recession. We're kind of dependent on debt. So we have a choice, basically. We either have, if we want more money to come into the economy, we have to go further into debt to the banks. If we say we've just had a crisis that was caused because people had too much debt, therefore we need less debt, the problem is we're going to end up with less money. And the government had a choice here between which of these two options it could choose after the financial crisis. And it went for this option. It's why ever since the crisis happened, you've had people saying, you've had politicians saying, look, we've got to get banks lending again. You know, even though the problem was banks lending too much, the answer is we need to get banks lending more. So this has meant that since the crisis, the total level of personal debt has hardly fallen. And it's now forecast that by 2018, personal debt in the UK will be as high as it was when the financial crisis hit. So that's dangerous. This guy here is the former boss of the Financial Services Authority, and he was just warning about this. He says, we got into this mess because of excessive creation of private credit and money. We should be concerned if our only escape route implies building up a future excess. So basically, we can't, if too much debt was the problem, then too much debt cannot be the answer. Okay. The next big consequence is on house prices. So a lot of people, particularly in this country, will have heard this story that, you know, there's too many people in the country and there's just not enough houses. Now, it's true that we've not been building as many houses as we need for about the last 20 or 30 years, but this is not the thing that really explains why house prices are so expensive now. This chart here goes from it shows everything relative to 1991. And this purple line, you can't read that, but this purple line is house prices. This green one at the bottom is the population. The red one is the housing stock, the number of houses in the country. So the number of houses in the country has been growing actually faster than the population. The only thing that really explains house prices is this one at the top, which is mortgage lending. And if you remember that every new mortgage loan is creating new money, what this is huge amounts of money flooding into property, pushing up house prices, making houses more expensive, and really requiring people to go further and further into debt. And that's what happened. As one of the main drivers of the financial crisis was the house price bubble. And it's also what is happening now in the last sort of couple of years. So for example, this chart here just shows you, if you're buying your first home, how much of your salary after tax is going on the mortgage. And you can see here, for the UK as a whole, it's about 30% at the moment for first-time buyers. It doesn't look too bad if you go back across the chart. It's, you know, roughly comparable to how it's been in history. But what's different here is that interest rates are at their all-time 300-year low. Once those rates go up, that cost of living for first-time buyers is really going to rise as well. So we've got potentially another housing crisis. A lot of people who've taken on mortgages that they can't afford, and this is really going to cause problems for people. Okay, it has a big impact on inequality. If you think that we're effectively renting all the money we use, and people have to pay interest on all of the debt that is created when this money is created, the result of this across the economy means that the bottom 90% of people are paying interest on net to the top 10%. So it's a continual redistribution of income to the richest. And again, through the housing bubble, when you push up the price of houses, those with the houses become wealthier. those who are frozen out of the market or can't get the mortgage in the first place because they haven't got the salary end up poorer and poorer and also paying off somebody else's mortgage. Right now, there's about 5,000 families made homeless every year. There are 3.9 million households, which is about 1 in 5, who only have enough savings for 1 month's rent or mortgage. That's a really dangerous situation to be in. You only need to be made unemployed unexpectedly, and within a month in that situation, you're in dire straits. The poorest 10% owe 4 times their household income. If you're in that poorest 10% and you owe 4 years of your income in debt, there's almost no chance that you will ever get out of debt. You'll be in debt until you either die or you declare bankruptcy. Okay, so how can we change it? So the organization that I work for, Positive Money, is campaigning for a reform to the way that banks work, which would fix this way that money is created by the banks. Something similar happened probably about 170 years ago, where in those days, the government only took responsibility for creating coins, and banks were actually able to print paper money. What would happen is you put your coins into the bank, they give you a piece of paper to say you have deposited £5, and then people started to use the paper money instead of the coins because it was easier. It was easier to carry around. It didn't weigh so much. And the banks eventually realized, hang on a minute, if people take these pieces of paper from us and we just write something on there, what happens if we just write anything? If we could actually lend money by just writing out more pieces of paper. And they effectively at that point had the power to create money. They, with that sort of temptation, they overused it. They created too much money, and it caused a property bubble, caused a financial crisis. This was back in the early 1840s. In 1844, the government stepped in and said, well, we're not going to allow the banks to create money anymore because they have too much incentive to abuse that power. And they passed a law, this was the Prime Minister at the day, passed a law in 1844 to say only the government, through the Bank of England, will be allowed to create coins and paper money. Now, obviously, in 1844, you didn't have any kind of electronic debit cards, credit cards, internet banking. There was none of this, and they didn't foresee it. And the way they wrote the law meant that it only applied to physical money. It only applied to coins and paper money, and it never applied to the electronic money that we now use for 97% of all the money in the economy. So what we're saying is that law should be updated, and there's 3 key things that need to happen. First, you need to take the power to create money away from the banks and return it to some kind of transparent, democratic, accountable body. Now, we know from history you can't trust the banks with the power to create money, but most people would not trust these guys either. Politicians would have, if you give politicians the power to print money, they have the same incentives as the banks to create too much. Before every election, you'll see huge amounts being created, paying for white elephants and whatever they think will win votes. So you need to separate 2 parts of the decision. One is how much money should be created, and that decision needs to be based on what the whole economy needs, not the needs of one particular industry or the banking sector. Second decision is, what is that money going to be used for? And what we're saying is there should be a money creation committee that looks at the whole economy and decides how much money should we create to keep the economy running, to keep people employed, to create jobs. That may be at the Bank of England, but it may be something completely new that's set up. The important thing is it needs to be as transparent and accountable to the public as possible. And then when they create money, it would be transferred to the government. And then, although there's many, many problems with the way democracy works in this country and every other country, at least the government has some kind of mandate to choose how to spend this newly created money. They could get it into the economy either through more government spending, so it could be building affordable houses, it could be any kind of government services that they provide. They could reduce taxes on everybody below a living wage, for example. So if you don't earn more than the living wage, you don't pay any tax. They could even just divide the money up between everybody equally, give everybody an equal share. And that option is usually quite popular when we do a show of hands. Okay, so when they did quantitative easing, the Bank of England created £375 billion of new money, but it pumped it into the financial markets, and it only really resulted in, because it's not easy to read, but it only actually resulted in about £30 billion of additional spending in the real economy. So about £30 billion of additional employment and real value creation. Most of the money stayed in the financial markets, where it pushed up stock prices, benefiting the richest 10%, but doing very little for everybody else. If you allowed the government to create money in the way that we're suggesting, and they get that money into the real economy instead, you would only need £10 billion of new money created to result in the same impact as that $375 billion that they created after the crisis. So it's far more powerful, it creates more jobs, it creates more employment, it gets the economy going again, without the impact on making the rich even richer that quantitative easing has had. Okay, the next thing is you need to create this money free of debt. So in the current system, money is only created when people borrow. In the system that we're advocating, money will be created without anybody actually having to go further into debt. And what this means is instead of having this catch-22 situation where you can either have more money and more debt, or less debt but less money, you can actually change the dynamics. As the state is creating new money, that money can come into the economy and it can be used to pay off the existing debts that we have. So you could really pay down existing household and personal debt. There would still be a role for banks, but they would actually be middlemen between savers and borrowers. They would no longer have this power to create money, and they wouldn't have so much influence over the economy either. And then the final thing that you need to do is make sure that that new money that is being created goes directly into the real economy. So, when banks have the power to create money, most of the money goes into the housing sector, the financial markets, and on personal loans and credit cards. What we need to make sure happens is that either money goes through investment into businesses, or it goes directly into people's pockets so that they can spend it in the real economy. So this is it's seen as quite a radical idea, even though actually the Tories implemented something like this in the 1840s. But it's becoming less and less radical. And this is an article by the chief economics commentator for the Financial Times, where he's now arguing we should strip banks of their power to create money. He refers to the book that we published under Positive Money and the ideas that we have in there, and says this is something we should do before the next crisis. He says, this proposal will bring huge advantages. It will be possible to increase the money supply without encouraging people to borrow to the hilt. It would end too big to fail in banking. It would also transfer seigniorage, which is the benefits from creating money, to the public. So the public would benefit from creating money instead of the banks. Now, so this is really the key question here. If money is power, which it clearly is in today's economy, then who do you want to have that power to create money? Should it be the same banks that have used that power to create essentially a huge financial crisis that has left the public with housing that almost nobody can afford, huge levels of debt, government services being cut in order to rescue the banking sector? I would say these guys clearly can't be trusted with that much power. And what we're arguing for at Positive Money is to take that power back to the public interest, to make sure that money is only created and used in the public interest, and that there's some transparency and democratic accountability over how this power is used. If you want to know more about the technical details, the Positive Money website is full of videos and things you can read that explain more about how this system works and how it could be fixed. We also have local groups around the country. There's about 30 groups at the moment. So you can get involved in there in campaigning for changing this. If you want to sign a petition, sign up on the website. We're going to deliver a petition to the new Prime Minister, whoever that is, saying that this is something they need to address in the next Parliament. And that's it from me. So thank you.
Okay. Right, thank you very much, Ben. That was excellent. I want to take a couple of questions. My lovely assistant here, Sarah, will be taking your questions, so do raise your hand. I actually have one of my own. The rhetoric coming from the establishment at the moment is all good, you know. It's like the economy's back, guys. Growth is back, jobs are back. Is that got anything to do with the 30 billion, like an initial sort of like a burst of light before the gloom, or have they fudged their figures?
It's driven by more money creation by the banks. It's driven by people going into debt. Consumer debt is on the rise now. People are borrowing more on credit cards and personal loans than they have been since before the crisis. Housing debt is going up. So in 2013 alone, the banks created £20 billion of new money just for mortgages. So that is basically £20 billion of new money coming into the property market, not financing building more houses, but pushing up the prices of existing houses. And so the economy, we're still in the situation where we have to drive the economy through going further into debt, and that cannot happen indefinitely. It's unsustainable, and at some point it's going to crash.
So a lot of the new jobs have been created through like lower sort of menial jobs or service sectors and financial systems.
Yeah, things like the 0-hour contracts. Apparently, I'm not sure what it is for the UK, but you only need to be employed for a few hours a week to not be considered unemployed. So you have a lot of people who are officially employed. This talk about having created 1 million jobs since the crisis. There could be 1 million jobs, but people working, one afternoon a week, not enough money to live on. So it's a bit of a statistical illusion.
Right. Okay. Can we have a question from the?
Hello there, Ben. Ivor Callott from St Albans. Thank you for your work. It's kept my sanity. In your experience of talking with MPs and sovereign money, do you get a sense of resistance there, and does that resistance come from stupidity and or ignorance, or is it more about ideology in terms of where they want the power base to lie, i.e. with large corporates and not with individuals and democracy?
Yeah, I think the big problem with MPs is just the lack of understanding. We did a survey last year of members of parliament to ask them if they knew how money was created. And 71% of them said that only the government could create money. So they actually don't understand the way the system works. There's almost no understanding of this, even at sort of quite a senior level. And until you understand that banks create money, you then can't make the connection to things like house prices and personal debt. Until you've made that connection, you're not really ready to talk about why the system needs to change. So one of the big things we have to do is really take a bit of time to help politicians to understand the way the system actually works. And that's quite a slow process, but it's necessary.
So you're saying George Osborne is ignorant and not?
He's definitely ideological, but I think he's quite ignorant of this issue. I don't think he has an informed position on it.
One more question?
Following on from what you've just been talking about, I watched the parliamentary, very poorly attended debate last year. I think about 16 MPs turned up. Has there been any follow-up, any outcome?
Yeah, well, quite a few of the MPs at that debate argued that we need some kind of official government study into how money is created and how that system can be changed. All of the investigations and all of the commissions that have happened so far have been just focused on banking and how to regulate banks. They've not actually been looking at whether the whole monetary system needs to change. So what we're trying to do now is really push for them to set this commission up. And it's on hold a little bit because of the election. Once we know who's in power, then we'll be able to start trying to work with people to push that forward. Yeah. Thanks.
One more.
Okay.
The last one.
Thanks for coming out. I was just wondering where you think digital currencies might fit in at the moment, because obviously a lot of it is solved by that.
Yeah, I think the Bitcoins and the cryptocurrencies are really interesting. I don't think they're going to take over. There's a lot of people saying, this will take over state currencies. and national currencies, but for the vast majority of people who've been using a particular currency their entire lives, it's quite difficult to convince people to try something else. There's actually a lot of trust in the national currency despite the problems with it. What I think is interesting is that the Bank of England now, they've set up a new research department which is doing essentially a bit of blue sky thinking. And in that, they've said, what is the relevance to us as a central bank of digital currencies? And actually, should we be issuing a digital currency? What I'm saying is they don't need to issue some kind of Bitcoin pound. They should just be creating money outright anyway, which they've been able to do. They could have done that electronically for the last 30 or 40 years, but they've just given up that responsibility to the banks. So, cool. Thank you. Thanks.
Thank you. Thank you very much. Okay, so I've come unprepared.